Ben Bernanke darkened his outlook but did not change the plans for the Fed. The central bank says that the U.S. economy is worse off than thought, and Greece's debt crisis is a very difficult situation. Our next guest says the Fed is firmly on hold, pending more information. Jim O'Sullivan is beside me here. He is the chief economist at MF Global. He is a Bloomberg best for his accurate forecasts on the economy. Jim, always glad to see you. Thanks
Deirdre.
for coming in. So the Fed is on hold pending more information. That was what you said yesterday. But do you think that Bernanke's message was dreary, as the Wall Street Journal suggested? Pretty strong words.
That might be a little too strong. I mean, he is looking for about a 1 percentage point drop in the unemployment rate over the next year and a half. He's still looking for about 3.5% growth going forward. I mean, he did mark it down by 3 to 4 tenths on a trend basis over the next year and a half. So he has lowered the growth projection a little bit, but it's still above trend growth, still brings down unemployment. And of course, he did raise the inflation numbers a bit.
Why do you think that Bernanke should be more optimistic, Jim?
Well, I mean, they're not really pessimistic, I would say, right now. 3.5% growth over the next year and a half wouldn't be bad. I mean, the question is whether they and people in general have over-extrapolated from some of the weaker numbers recently. I mean, I think it's still true.
Japan, for example.
Japan, obviously, the jump in oil price in the first quarter, which seems to be largely behind us at this point. There was also extreme weather in the U.S. in April and even May to some extent, with tornadoes and flooding, etc. But at the same time, as he pointed out, there are still headwinds clearly holding back the recovery. And the question is, over time, to what extent those headwinds fade. And you are left with incredibly accommodative monetary policy.
Now, you mentioned the increase in core inflation expectations, what they are expecting to see. Is this why we heard absolutely no hint of QE3?
Oh, absolutely. And he made that very clear, I think, in the press briefing afterwards, that the world is very different from last summer. I mean, last summer, they were clearly saying they are failing on both parts of their dual mandate. Unemployment's too high and inflation's too low. And to me, the big change in yesterday's statement was the dropping of the reference to inflation being too low. So that's not true anymore, is what they're saying. They still have unemployment too high, but it's not as clear a signal in terms of potentially adding more stimulus. So at this point, inflation is pretty much back to where they want it to be in terms of underlying inflation. Unemployment's still too high, but again, they do still think the trend is down from here. So it's not that pessimistic.
So given all this information, when does the Fed move?
Well, it depends, of course, on the outlook, as the chairman himself would say. What I would say is, if you take their projections as they stand yesterday, even with the revisions, and plug them into, say, a Taylor rule type model, and admittedly there are different types of Taylor rules, but they clearly imply tightening in 2012. Now,
Which,
exactly
by the
when,
way, market does not foresee that at all, or is not baking that in at all.
The market's got about 25 basis points of tightening for the whole year, and that's all at the end of the year. But again, if you plug those projections into a Taylor rule, and again, there are different versions of the Taylor rule, you unambiguously would get tightening in 2012. In fact, if you take their numbers as they stand, adjust for the stimulus from the increase in the balance sheet, which supplements conventional stimulus, and take the original Taylor rule, you would come up with a 3% funds rate at the end of 2012. Now, I wouldn't say take that literally, and there are different versions of the Taylor rule based on empirical calculations of the coefficients, et cetera, and you might get something more in the 1 to 2% range. Again,
but
adjusting for the balance sheet.
Basically, you're saying, hey, spring, like March 2012, we could see tightening.
If unemployment is coming down, then ultimately the Fed is tightening. But again, that's the big if, of course. And of course, right now, there are still doubts about the recovery.
Are you reassured at all about the U.S. exposure to Greece? I was actually surprised, Ben Bernanke, because he had no choice but to talk about it. But he did make a very specific comment.
Yeah, I think he answered it pretty clearly. I mean, he said the direct exposure is tiny. But of course, the broad indirect exposure can be huge. And of course, if European banks had to take a big hit and there was another round of a severe credit crunch in Europe, then inevitably that would affect our banking system as well. So there are a lot of indirect effects, and the numbers that way can get pretty big, even though the direct effects are quite tiny.
Jim, thanks as always. Jim O'Sullivan here with us, chief economist at MF Global.